Welcome to our 2018 webinar series. In case you didn't know, 2018 marks LLIS's 20th anniversary. Each webinar this year will involve the number 20. Included in each webinar are advisors' requests for specific information from the 2017 webinar surveys, so watch for a question you may have submitted. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's webinar will be recorded and be posted on our website within a week in case you missed it. And throughout 2018, loyal fans will receive 9 CFP CE credits, 1 for each month. And who knows, maybe one lucky viewer will have a chance to win a 20th anniversary gift from LLIS. Today's presenter is constantly monitoring the changes in annuities and hybrid insurance combos to ensure your clients are getting the most up-to-date solutions. He joined LLIS in 2008 and has over 20 years analyzing, studying, and researching annuity solutions. Here to share all his knowledge on annuities is Jerry Skapiak.
Thank you, Claudia. All right, so today we are going to talk about a couple of different things. One of my favorite subjects, in which I believe is the probably #1 annuity product advisors use, or at least use to put new money into, and that would be immediate annuities. We're going to spend some time going through the 20 critical pieces of information that are needed on our quote request. Some of them may seem very trivial, but I'm going to show to you how they can impact the quote that's provided to your client. We're also going to go over a case study for immediate annuities, and then we're also going to touch on fixed deferred annuities, especially in today's rising interest rate environment. They are starting to become more popular. So let's start with immediate annuities here and the 20 critical pieces. So first, who should consider an immediate annuity? Well, first off, it should be someone who wants guaranteed income. If it's a client that is not concerned about guaranteed income, then they're definitely looking at the wrong product. That's the one thing that immediate annuities do, is they are going to provide guaranteed income in almost all cases for the life of the insured. They also should be more on the conservative side of an investor. Since these are guaranteed products, they're going to receive that guaranteed income. This type of investor is going to be more concerned with the ups and downs of the market, as opposed to some of your other clients. We also see this more with older clients, and when I say older, I'm talking about age, around 70 or older, are looking at the immediate annuities. If you got an investor who wants to lock in gains and convert those gains to income, with the immediate annuity, everything is guaranteed with it. They need income within the next 12 months. With an immediate annuity, you can defer that first payment or you can start that first payment immediately, meaning the day after it's issued, the policy is issued, or you could defer that first payment up to 12 months out after the policy's been issued. Anybody who needs income to start later than that, we would need to look at a different type of annuity product for them. And also, who should consider this is someone who has old life insurance or an annuity. So first, they should want guaranteed income. And then if they have like an old cash value life insurance policy or an annuity, we can look at doing a 1035 exchange into an immediate annuity to provide that client with guaranteed income. So these are really like the type of clients who have these types of needs or wants or concerns here, would be kind of like that ideal client to consider an immediate annuity for. So anybody who's been out to our website and has requested an immediate annuity quote, this is what it looks like. And what I want to do is we're going to kind of walk through this today, going over what the different inputs are on it and how they're important. First, no matter which product you click on our website for quote request, the very first thing that we ask is the advisor information. If your clients are going to be filling this out, please make sure they fill in your name and your company name. What this does is this ensures that we are going to be copying you on the quote request or on the quotes that we're going to send out to your clients. Very important. We like to get that up front so we can make sure we keep you in the loop throughout this whole process with your clients. Next, first name and last name. This is what we use to track everything we do for your clients. It is all based off of their name. I know sometimes advisors are a little hesitant in giving us their clients' names. For those of you who've worked with us, you know we don't do anything with your client's information. It is used to put their name on the illustration, and then we use it to track everything we do for your clients. If you've been out to our LLIS system, which is our portal that we have for advisors and clients, you can go in there and you can see everything that's been done for your clients through this, and you'll notice it's all tracked by their name. Date of birth. A lot of times I'll get advisors saying, I just need a quote for a 65-year-old male. With immediate annuities, the date of birth is actually very important. A lot of companies, every month you get older, that payout will also change. So to give you an example, if someone calls up and just says, my client's 65, I'm going to assume they just turned 65 when I run that quote. As you can see, for a 65-year-old, this is a $100,000 premium. Their payout's going to be right around $549 a month. Now, if they were 5 months younger, you'll see the payout goes up a little bit, about 0.9%. And if they're a little bit older, say they were born December 6th of 52, they're still 65, but now their payout's 555, and we're looking at 1.2% higher. Or if we go out to where they're actually getting ready to turn 66, so they're 65 and 11 months old, you see that payment's 561, 2.2% higher. So it's really important that you provide us with the client's date of birth so we can provide you with the most accurate quote possible, especially if you're going out and comparing us with other sites. I will tell you, we do work with over 15 different companies for immediate annuities. So we do a lot of that shopping for you. Also, I know a lot of you like to go on Vanguard and use the Hewler website. The company that we primarily use for immediate annuities is Integrity Life. You'll notice they're on Hewler. But if you get a quote from us, you also notice that our payout's going to be higher. With all of Hewler's products on there, there's a 2% commission factored into those. With the Integrity version that we use, it's only a 1% commission that's paid to LLIS. So it has a slightly higher payout for your clients. So while we're talking about date of birth, I also want to talk about how just besides having a date of birth being accurate, also having an accurate age in general for a client. So here we have my $100,000 premium, and you can see how the payouts vary between age 60 and 75. There's quite a bit difference. And the reason those payouts are going up as you get older is just simply because the client's not going to live as long for it. As you can see, between 60 and 65, the payout is 10% higher. Between 65 and 70, it's 12.2, and 70 to 75, it's 14.9%. A common question I get asked is, should my clients wait to buy an immediate annuity because they are going to be older? They're going to get higher payout, and that statement's true that the older the client is, the higher that payout's going to be. But what a lot of times is not factored in is instead of buying, like for example, buying the annuity at age 60 and waiting to age 65, you're missing out on that income over those 5 years. So if you look at it between waiting to age 60 to 65, and this does not take into account interest rates at all, this is assuming interest rates remain the same, it takes 54.9 years to break even. So yes, you do get more income, you know, $50 more a month waiting to go to age 65. But since you've lost out on all that income for those 5 years, that $50 extra income you get, it's going to take 54.9 years to break even, which is more than likely going to be well beyond the client's life expectancy. And that same holds true even going from 65 to 70 or 70 to 75. So it doesn't pay to wait to buy an immediate annuity because the client's going to be older and they're going to get a higher payout. As I always tell advisors, if the client needs guaranteed income today, then today's the right time to buy it. Also, this doesn't take into account, going back to the example of 60 to 65, not only does it take 54.9 years to break even, that money that they're not receiving has to come from somewhere else. So it's the break-even point is even much farther than that out there. Moving on, this is kind of strange. Some advisors are kind of surprised by this, that we ask, is your client a U.S. citizen? If they are, no problems. They can purchase immediate annuity, no questions really asked. It's when they're not a U.S. citizen where it can become an issue. So if the client's, a permanent resident or green card holder, they're fine to buy an immediate annuity. It's for those clients that are just visa holders. They are not able to buy an immediate annuity. And this really goes down to money laundering and anti-money laundering laws. The U.S. government just does not allow them to be able to purchase an immediate annuity. Number 5, contact information. For clients, obviously they're going to fill out their information in here. For advisors, sometimes they get a little hung up on this. Do they put the client's information or what should they put in, because it is a required field. If you don't want to provide the client's information, that's fine. Just fill in your information. Put your phone number in there and your email address in there. And we'll get you by this step and we'll send the quotes out to you. City and state. City is not so much important with an immediate annuity, but the state absolutely is. Why is the state so important? Because some states have a premium tax. As you can see, for example, Florida has a 1% premium tax, but that's absorbed by the insurance company, and that's, for some reason, Florida is the only state that's done in. If you look at California, for qualified money, which is the left column, it's a 50 basis point premium tax. For non-qualified, though, it's 2.35%. Nevada, they don't charge anything for qualified money, but then they charge 3.5% for non-qualified money. So the state matters. Maine, again, no premium tax on qualified money, but 2% for non-qualified. So here we have David, who's age 65, $100,000 premium. If he was to use qualified money, that payout's going to be $549. If it's non-qualified, it's $538. So they're taking that 2%. So they're taking $2,000 out of that $100,000 upfront to pay that premium tax. So in a sense, what they have is only $98,000 on non-qualified money to go in and buy it. I've even back tested that, used $98,000 of qualified money, and lo and behold, we get the same payout as if it was a qualified. So the premium tax can impact the payouts, but that's the same no matter what insurance company the client ends up purchasing an annuity from. New York, that's a special state all on its own. With New York, the insurance company has to be domiciled within that state. So what that does is that has a limited number of companies that actually do business in New York. I was talking before about Integrity Life. They're the company that has the low load version. Their New York company is National Integrity. And what they've done is with National Integrity, it's from New York up north. So you got a couple of other states up above New York that are also fall under National Integrity. Doesn't matter, the payouts are still the same. It's just that the company has to be domiciled in New York. And you'll see a lot of companies like American National. Then for New York, it's American National Life of New York. You'll see that with a lot of companies. It's just something to keep in mind for if you have any clients that are in New York. You're going to probably see different company names you may not be as familiar with, and the number that are available is going to be smaller than what you're typically used to seeing in all the other states. Male, female, another very important piece that we need to know. There is a difference in the payouts for males and females. Here's an example: $100,000 premium, male age 65, $499 a month. Females only $482. Why is there such a difference? Simply because males don't live as long as females. Insurance companies pricing in that with a female client, they're going to have to make more payments on that annuity. So they're just simply going to have to pay out more money. So they lower that payout initially. Look at 75, 708 versus 673. So you see a bit of a difference with that. You also see a difference when we look at a joint. So what we're looking at here is like a joint age 60, joint age 65. The 65, you'll see the payment goes from down to 476. The reason for this is that there's a likelihood that one of them is going to live beyond the average for if they were just an individual. So the payouts are a little bit lower when we're looking at joint policies. But it also guarantees that payments are going to continue to both of them, or continue to one of them as long as they are alive. Will there be a joint annuitant? Obviously, it's important if we're looking at a joint life payout. So we do need their name. We definitely need their date of birth. Are they male or female? With an immediate annuity, they don't have to be the same sex. They can be a same-sex couple. The date of birth, they don't have to be the same generation. They could be of a different generation even to purchase an immediate annuity. And then we have percentage paid to survivor. You may see this more so with pension options that your clients may have come to you with, but with an immediate annuity, you can mimic that. So here's an example. So typically, the less of the payment you're going to guarantee to the survivor, the higher that initial payment is going to be. So if we look at the top line, percentage paid to survivor is 33%. That initial payout is going to be $526. But once one of them passes away, that payment's going to drop all the way down to $174. Only time I really use any of these reductions is if we're comparing to a pension payout. If we have a couple and they're looking to do a joint payout, it's almost always 100% joint and survivor. So it would be the $468 a month payout. By far the most common when looking at a joint. Tax status, qualified and non-qualified. I'm kind of a little embarrassed to say this, but I have been asked in the past by advisors to explain the difference between qualified and non-qualified money. I'm assuming maybe they just knew it by a different name, but just so we're all on the same page, qualified money is money that taxes have not been paid on. So like money out of an IRA, 401k. Non-qualified is after-tax money. So as we saw before when we were looking at why we need to know the specific state the client is, because there could be a different premium tax depending on tax qualified or or qualified or non-qualified. Here we have Matt, age 65 with $100,000 premium. Nevada, if you remember, they had a 3.5% premium tax on non-qualified money. As you can see, it makes a big difference in the payouts in Nevada, whether the client's going to fund it with qualified or non-qualified. So one of the benefits to non-qualified is you do get an exclusion ratio with that, and qualified, it's all going to be taxable, all those payments. Single premium deposit or desired benefit amount. Both are used quite often by advisors. Obviously, single premium, you're just going to looking to put in a specific dollar amount, and what is that payment going to be a month to the client. With non-qualified money, the maximum amount that a client can put into an immediate annuity is 50% of their investable assets. This question comes up actually fairly often. There is some wiggle room on this rule. For older clients, they can typically put in more than 50%, but as a rule of thumb, it is best to go by that 50% rule. For qualified money, clients can put in up to 100% of their qualified money into an immediate annuity. Going back, a desired benefit amount, that would be like if we're looking to solve for, my client wants to receive $600 a month, what is that single premium we need to put into the annuity? But once again, with that, I still need to know, is the money coming from qualified or non-qualified money that's going to fund the annuity? And then the dollar amount, whether that's going to be $100,000 single premium, or are we looking for $600 a month to get out of the annuity? And then you have different payment options or frequency of payments. It can be monthly, quarterly, semi-annual, or annual. I will say monthly, hands down, is the most common. I'm not even sure if I've ever really seen anybody request quarterly or semi-annual. Where we'll use annual a lot of times if we're going to use the annuity to fund life insurance. I've seen that done, but vast majority of the time it's going to be done on a monthly basis. The payment options, very important with immediate annuities. Life only payout option. So what the life only is going to do is that basically the annuity is going to pay for as long as the client's is alive. Once they pass away, those payments are going to stop. Because of this, insurance companies are predicting that any client who is purchasing an immediate annuity and they're looking at some type of like life only or life in period certain payout, they're assuming that client is going to be in above average health. So they're actually, like, if you look at like for life insurance underwriting, they're assuming the clients kind of fall in that preferred health underwriting class. So any clients who are looking that maybe want to do a life only, they should be in good health to do it, because one, they want to live as long as possible to take advantage of that guaranteed income and to hopefully receive back more than what they put in. Also, where we see life only used a lot is if the clients have no beneficiaries at all. Life only is a great option for them, and life only pays the highest amount. Life in period certain, we're starting to add guarantees on to the payouts. Anytime you add a guarantee on, the payout's going to be a little bit lower. When we get done going through this, I'll show you an example of how the different payout options affect the payout to the client. But a life with a period certain, we'll just use, for example, a life in a 10-year period certain. That annuity is guaranteeing that the annuity is going to pay for as long as the client lives, or at a minimum of 10 years. So for example, the client takes a life and 10-year period certain annuity out and they pass away after 8 years. The annuity didn't fulfill the period certain part of that, so it will continue to make payments to their beneficiary for the next 2 years, fulfilling that 10-year period certain. If the client passes away and it's been 10 years and a day, the annuity stops because that period certain has been fulfilled. Another payout option, period certain only. So this type of annuity is going to pay for a specific period of time. Common would be 5 years. We see a lot of advisors have clients retiring, say in their early 60s or 65 or whatever that is, and they want to delay taking Social Security. So they'll look at using a period certain annuity to cover that span until Social Security kicks in. Also, where we use period certain a lot is if a client is inheriting an annuity that has a gain in it. With annuities, if you just take a withdrawal out of annuity, the gains come out first, so they're taxable to the client. So what we'll do if they inherit an annuity and there's a gain in it, we'll look at a 5-year period certain. What that simply does is that spreads the taxes out over those 5 years. My two favorite options are life and installment refund and life and cash refund. What these options do is they guarantee that the premium paid in will be paid out. So say, for example, a client puts in $100,000 and they pass away after receiving only $80,000 of income. The installment refund option will continue to make premium payments to the client until that other $20,000 has been paid out. The cash refund option will simply just write a check for $20,000 to the client, fulfilling that refund part. If the client passes away, they received $100,001, they're beyond those installment cash refund periods there, the annuity would end. My two favorite options, and they're probably the two most common options that we use. Third would be just a straight life only. So here we have Eric, $100,000 premium, and this I put this in here to give you an example to see what is the cost for these guarantees. And something I want to point out is the younger the client is, the less these guarantees cost, and the older they are, the more the guarantees are going to cost. If you think about it, if you have someone who is 75 and they want to look at a life and 20-year period certain, that annuity is going to be guaranteeing, the annuity is going to be paying out if they're 70 all the way out to age 90. So that payout is going to be lower. So it just gives you an idea of the cost on these. So they do cost a little bit more for them, but as you can see, like in this example, life and installment refund, life and cash refund, a little bit less than the life only, but it gives clients peace of mind that they know the insurance company is not going to win, that the insurance company is not going to keep their $100,000, that someone's going to get the full benefit of it. I see I've had some questions come in here. Let me see. Did you mention we can get a copy of the slides? Yes, we will make the slides available for everybody. Can a U.S. citizen living abroad with no U.S. address buy an immediate annuity? Unfortunately, they cannot. In order, and this is really goes for any insurance product, first off, they have to be on U.S. soil to sign the paperwork. If it's life insurance, to do the interview, they have to be on U.S. soil to also take delivery of that policy. Excuse me. Also, what's required is that the citizen has to have a U.S. mailing address, and they also have to have a U.S. bank account. So for the annuity, they have to have a U.S. bank account to where the payments can be sent to. And if they were, like, for example, buying life insurance, the premium payments for that have to come from a U.S. bank account. What is the shortest time frame for a period certain only? annuity, that would be 5 years is the shortest that is available. Are the premium refunds taxable? If it's a non-qualified annuity and it's going to stay below the cost basis of the annuity, then no. If the payments go above that cost basis, the guaranteed payment amount, then yes, it would be taxable to the beneficiary. How does a period certain compare with a bond ladder? Sorry, I don't do investments. I cannot answer that question for you, unfortunately. If an insurer fails, what % of the benefit is likely to be backstopped? So with all insurance products, there is the guarantee fund with every state. And we'll use a simple example. Let's say that guarantee fund is $100,000. If you look at what I've been told is one of the worst cases of an insurance company failing, the insurance company was still able to meet 90% of their obligations. So we'll just use simple numbers. Let's say the client's receiving a $1,000 payment. Insurance company fails, they're able to receive, or they're able to pay 90% of their obligations. So of that $1,000 payment, the insurance company is able to pay $900 of that $1,000. State Guarantee Fund has a $100,000 maximum that they'll cover for each individual annuity. And in the example, the State Guarantee Fund is going to have to make up $100 of that $1,000 payment, because that's what the insurance company doesn't have to cover. In my example, that $100 is coming out of that $100,000 guarantee. Client's never going to live long enough to deplete that $100,000 of that guarantee. Now, when an insurance company runs into financial trouble, there's a couple of things that happen. First, what happens the vast majority of the time is another insurance company will acquire that company that's run into financial trouble. That happens the vast majority of the time. If the state's not able to find a purchaser of the insurance company, what will happen next is the books of business will be sold off to other insurance companies or investment firms, which is what we're kind of seeing now. It's only if those first two can't happen that the state comes in and takes over the insurance company to run it, and that's where the State Guarantee Fund is backing everything up at that point. All right, that is all the questions that I see so far, so we'll continue on here. First payment. So what is most common with an immediate annuity is starting that first payment 30 days after the policy is issued, or we'll see a lot of times postpone that payment 1 year from the date of issue. Or there's another. You can pick a specific day of the month you want the payments to happen on. You can say you want the payments to start in 3 months. You can choose anywhere from immediately out to 12 months into the future. And where you would write, like how we have other here, you would write that down in this customization area of the quote request. Also, you can put any kind of notes in here. If there's anything specific you want to see with the annuity that wasn't covered up above, or if you want to see different dollar amounts, you could put all of that in there. That's why those boxes are on all the quote requests. So you can customize them and tailor them the way you need it for the plan you're putting together for the client. Immediate annuities are extremely interest rate sensitive, and the rates on these annuities change all the time. Some companies change them weekly, some do it every 2 weeks, some do it every month. Depends on the company. We ask this to know if they're going to be purchasing in 2 weeks or not, to give us an idea of how we should be quoting this for the client. If you say, no, they don't need it in 2 weeks, I'm going to send you a quote for Integrity Life because about 99% of the time, they have the highest payout and they're an extremely highly rated insurance company. And that's who we'll more than likely end up going with. If you're saying the client's going to be purchasing within 2 weeks, I will give you quotes of other companies also, just so you can talk and show the client that due diligence has been done to show them what company has the highest payout for them. Have you applied for life insurance, disability, health insurance within the last year? Seems like kind of like an odd question to ask on an immediate annuity quote request, but it does come into play. If they mark yes, then this box is going to open up. Please specify company types and amounts of insurance. What we're really concerned with is if they've been declined for coverage and the reason for that declined. This is for us to do due diligence to make sure your clients are purchasing a product that's appropriate for them. If a client, applied for life insurance and they were declined because they had stage 4 cancer, buying an immediate annuity with some type of life-only payout is probably not going to be the best option for them. If they're looking to do a period certain, that would be fine. But we're just looking for this so we can do our due diligence to help protect your clients. Okay, we covered that. Delivery options. Date quote needed by. It just helps us prioritize when we're running quotes. Vast majority of the time, you're going to get your quotes out to you within a 24-hour time period. But this just helps if we get an abnormal amount of quote requests in a single day to help us prioritize which ones to send out. What is important is who to send the quotes to. Is it going to be the advisor only or the client? It just helps us know who do we need to send this quote to. And then, just additional details here. If there's anything else you need to tell us for the quote, you can fill it in there to give us the information. All right, so now we're going to talk about a recent client that we had coming to us to purchase an immediate annuity. So here we have John, age 68, and Laurel, age 64. John had a life insurance policy, had $183,000 of cash value in it. Cost basis was about almost $112,000 in the annuity. He's getting ready to retire. He didn't really need the life insurance anymore. So he was talking to the advisor about what can we do with this. And the advisor mentioned to him, well, since you're getting ready to retire, we can use that cash value to get you some additional income in retirement and not necessarily tap your assets that he's been saving. So what we did is we looked at joint payout options for them. And you'll notice on here we have the exclusion ratio. What that is telling us is what percent of those payments is going to be excluded from taxes. So this just goes into why we need to know what the cost basis is when we're running a quote for your clients. What this client actually ended up going with was the joint life and installment refund. As you can see, a joint life only was $877 a month. The installment refund option was $869 a month. Doesn't cost very much to guarantee that that premium that's paid in is going to be paid out at a minimum. And finally, we're going to talk a little bit about fixed deferred annuities. So we're in an increasing interest rate environment, and almost on a monthly basis, I've seen these rates going up. And these are current rates, what we're able to get today. Comes from a variety of different companies with fixed deferred annuities, like the immediate annuities. We work with about 15 different companies. And typically when you come to me and you ask for a fixed deferred annuity, I'm going to send you an email and I'm going to give you a breakdown of interest rates like this, which insurance company goes with each rate period, what surrender charges typically match the rate period. So if you go with a 7-year rate at 3.4%, you're going to have a matching surrender charge with that. These annuities also have surrender charges. Even on low load versions of fixed deferred annuities, you cannot get away from surrender charges. I wish we could, but unfortunately we cannot. And these annuities also have something that's called a market value adjustment. And what that basically means, if you think of the pricing of bonds, so if you're let's use the 7 here, if you client purchases that, they're getting 3.4%, they decide they want to get out of the annuity early, they'll have a surrender charge, and then there's this market value adjustment. If interest rates are higher, it's going to be a negative market value adjustment, so they're going to take a little bit more from the client. But if interest rates are lower, they're going to give them more money than what the surrender value is of the annuity. So it's meant to be impartial to the insurance company and the client. It's just kind of like the pricing of bonds. But when we look at the rates that we see here today, we're seeing a lot of advisors taking advantage of the 3-year or 4-year rate and that 5-year rate. Going longer than 5 years just doesn't really make sense right now, because you're really not gaining anything, or you may even be losing some if you go out to 8 or 9 years. The reason the rates are lower on 8 or 9 years, there's just not many companies that offer that rate period. So there's not the competition where we're like the 10, the 7, the 5, and the 4. Most companies offer those rate periods, so we see more competition there, and so they'll generally have a little bit better rate on those rate periods. So I want to go over a case study. And this is something different. If you sit there and think about your clients, this may apply to some of them. Client Sam was 87. He actually had fixed deferred annuities. He actually had over $1 million in them. I think it was about 4 or 5 annuities. There was over $1 million in each of these annuities. Sam never planned on spending this money. Now, with annuities, I kind of mentioned this before, I want to mention it again. If you take money out of an annuity, the gains come out first, so they're taxable to Sam if he was to do that. So he didn't want to take the money out of this annuity. Okay, that's fine. We could leave the money in an annuity. But his current annuities came up to the end of their rate periods that they were at. And Sam just wants to pass this money on to his kids. Now with annuities, they have maximum issue ages, and the maximum issue age for an annuity is 90. So remember, Sam is 87. If he stayed with his current annuities, he's going to get just a 1-year renewal rate, which is more than likely going to be the guaranteed minimum for that annuity. So the advisor came to me and said, what can we do to help Sam? So even at 87, with the variety of companies we work with, we had options, 3 to 10-year rate periods available to him to consider for his annuities. So what we did is we took his current annuities and we did a 1035 exchange into new annuities. Now, what may be surprising to a lot of advisors was we actually went into the 10-year rate for all of his annuities. The reason we did that is because if we went with a shorter rate period, once he reaches the end of that rate period, he's too old to buy a new annuity. Therefore, depending on the company, he would either have to cash the annuity out, or if he was lucky, he would be able to renew that annuity at the 1-year rate period once again, which would be at probably more than likely the guaranteed minimum. And guaranteed minimum on fixed annuities right now is either going to be 0.5% or 1%. So what we did, we went into that 10-year rate to guarantee him the highest interest rates we had available at that time, basically getting him all the way out to age 97. And then at the end of those 10 years, the company we went with, it's going to go into a 1-year renewal rate. So he won't be forced to cash out the annuity. Worked great in this situation for this client. Let's see, we got another question mark. What benchmark interest rate is most influential in quote payment amounts, and how long after rate change do insurance companies reflect the payment changes in their quotes? Okay, so what the question's basically asking is there a benchmark that can be looked at to gauge on what the interest rate or what interest or how interest rates are going to move inside of immediate annuities? And for a benchmark, I would say you could just kind of look out there at a 10-year rate, but it takes time for it to translate into the payouts of an immediate annuity. And the reason for that is the insurance companies are going out and buying bonds, and most of the time they're buying corporate bonds. So however long it's going to take for those rate changes to move and influence the corporate bond rates is how long it's going to take before we see any changes in the immediate annuities. And it also depends on what the insurance company is able to purchase as far as bonds go. Even where we've had interest rates going up pretty much this whole year, we have seen times where the payouts have went down a little bit. And it all comes down to what the companies are able to buy in their general account to back those payments. That's why I say the payments change all the time. When you get a quote for an immediate annuity, typically that quote is only good for 7 days. Once they have an application in-house, if we're doing a 1035 exchange or a rollover from a qualified account, you generally get another 45 days. But generally, we got to have that application into the home office before the expiration date on that quote. And that's something we watch here. A lot of times as the process is going on, we'll be running new quotes in the background here to push out that rate lock if we think the client's not going to have applications back to us in times. Okay, I got another question here. How are the beneficiaries of annuities taxed after the original owner dies? If it is a fixed deferred annuity, any gains in that annuity are going to be taxed to the beneficiary. It is not a death benefit on an annuity is not like a death benefit on a life insurance policy, where life insurance, the death benefit is tax-free. It does not work like that with an annuity. The taxes are payable on any of the gains in the annuity. That's why I was kind of saying if a client inherits an annuity that has a gain in it, they'll look at doing a 5-year period certain payout so they can defer those taxes or spread those taxes out over those 5 years. So today we covered the 20 critical pieces of the annuity quote request. We talked about immediate annuities. We looked at fixed deferred annuities, and I hope kind of put out a unique case study there as to where we've used the fixed deferred annuity in the past. Join us at some of the upcoming webinar or upcoming conferences. The next one's going to be the Garrett Planning Network, August 2nd to the 5th. We'll be at XYPN Live, NAFA in the fall, and ACP in November. And for those of you who may be new to us, top 10 things that make LLIS different. Well, one, we do these free monthly webinars. Almost every month. We are skipping July just because we have so many people out on vacation here. But we're going to kick it back up in August, talking about hybrid annuities and other insurance combo products. And I will be hosting that one for you also. As you see, we got some other ones on here. But some other things that make us different. We are not your competition. We view ourselves as your back office. We do what it is you ask us to do for your clients. We save advisors time and your clients money. We do that a lot through a lot of our upfront underwriting that we do to make sure that we're quoting your clients accurately and putting them with the correct company upfront. If you get a chance, go to our website, LLIS.com. We have an advisor tool section on there that has a lot of useful tools for advisors when working with clients. We are proud sponsors of these various organizations. You've heard me all mention them because they all have conferences coming up yet this year. We have specialists in the different lines that we work with. So we have life specialists, disability, long-term care, annuities and hybrids. I am your annuity and hybrid specialist. I also do a lot of the term insurance for the office. We manage your clients' policies both now and in the future with our APE and note system. I love this advanced premium email system, the APE system that we have. What that does is that's going to send an email out to you and the client about 30 days before their premium is due to let you and the client know to be on the lookout for that premium notice. It's amazing how many clients have moved and don't tell the insurance company that they moved and have had policies lapse simply because they never got that premium notice. This has greatly cut down on the number of those lapses. And then finally, I hope you've all have met LLIS right now. This is our secure access anytime, anywhere, 24/7, 365 a day system that we have in place for you. You can share sensitive documents to us through that LLIS system. It's all encrypted. It allows you to see all of your clients, what we've done for them, if they're in the underwriting process, where they are in that underwriting process. Advisors have been raving to us about this and how much they love this system. So at this point, I have completed. If there's any other questions, please type them in and I'll be happy to answer them for you. We'll give it a minute here. So it's probably a good thing we're about ready to get done here, because I'm hearing for those of you who don't know, we're in Tampa, Florida, and I hear our afternoon thunderstorms brewing out in the distance, so it may be getting noisy here in our office in a minute. Well, I don't see any questions coming in. Thank you, everybody, for attending, and I'll talk to you again in August. Thank you.